Our next panel will complement what we have discussed this morning as it explores how to establish a standardized definition of terms, such as impact investing, and developing a framework for measuring impact investment, whilst analysing both the risks and the benefits of doing so.
The moment is really important to have this common, I would say, collaboration between academia and research. ESG area is quite evolving and growing very fast. Once we have a proper, rigorous methodology to inform policy and to inform our clients forming their portfolios, this is really a key. So the data and the validation of the data is a matter of concern, I would say, at the moment. But I will tell you what is the reflection from the academic research at the end of the panel discussion in the conclusion, if I may, just to keep you attracted to the discussion. So there are some controversial corporate response. We will not name any companies, but I will give a couple of examples in order just for us to reflect what's next. So if I may start with you, Maggie, if I may. Okay. What do you think about the definition of sustainable investment? What does it mean to you?
Yes. Well, first of all, thank you very much for having me today. It is true, there's a bit of an acronym soup when you go into this area of investing. And I think that that's one of the areas that investors do find challenging. Regulators haven't stepped in and given precise definitions of what a sustainable investment is, but they've given overall guidelines for things that you can consider. But that means that in the absence of concrete definitions, investors are having to figure out their own definitions. And so I think that when you're looking, and we do an investor survey every summer, we ask this question, and one of the things that came back was that investors are looking for revenue alignment with the SDGs, so the UN Sustainable Development Goals, as one of the overarching areas. And one of the reasons that I think that that is often used is that it allows you to invest in a wider universe of names. And if you have more tightly defined, like say with a EU taxonomy aligned revenues, but that revenue piece is one that a lot of investors are very focused on. I think that if you're looking at the fixed income side, you have the advantage of having use of proceeds bonds, so green bonds, social bonds. Those ones are widely viewed as a sustainable investment because you can see exactly where those funds are going for more sustainable projects. But if you're trying to invest more holistically, I think trying to see what the company is aligned to is still very important. What was interesting in the survey, and I think particularly if you're taking a step back and thinking about how to invest in companies that are earlier in their stages of transition, the fact that so many people do look at that revenue piece rather than, say, looking at CapEx is something which I hope is going to evolve. I think one of the reasons that investors often do go or gravitate towards revenue is there's simply more data on it, and companies are more willing to talk around what they're already doing and how much of the revenue might be aligned to, say, certain sustainable development goals. But I think if you're trying to invest in a company that's transitioning, that CapEx piece is going to be very important. And I'm hoping that over time, also as companies get asked more about it, they start talking around the plans that they have, because then instead of investing in companies that are very good, sometimes by virtue of their starting point today, that you can actually start investing in those ones that are trying to make transition a reality, who might, for whatever reason, be at a different stage in their journey, but are still doing really very exciting and very necessary things to move things forward. So right now, revenue alignment is what investors are frequently using. I hope that CapEx becomes used more broadly as we move forward. But there isn't yet an absolute definition. I do think also regulators are in a bit of a tough spot, because if they were to give a very strict definition of what a sustainable investment is, that runs the risk of becoming too static very quickly, because the space is constantly evolving and changing, and you want the markets and the finance flows to be able to still be able to move forward with that.
So you touch base on the revenue and CapEx. So are there any other data point you want to reflect as maybe determining what makes a sustainable investment?
A lot of companies do want to do the right thing, but I think from the investor perspective as well, to make sure that you understand what you're getting into, spending that time engaging with the company to understand the project, the expected outcomes, and the payback periods. Those are all very key. And I think that it's also looking across a wide range of opportunities, making sure that what that investment, whether it's revenue or CapEx alignment, how it also fits into the overall aim of the company. What's the strategic vision of the company? Where do they want to go? Where do they see the opportunities? And how is that going to help society go towards where it needs to go as well to reach some of these overarching goals?
What's your advice to clients they want to assess the particular company? Because they are different, industries are different. So the transition process vary from one to one. So what's your thoughts about this?
It's true, and actually, it was a topic of a breakfast that we were having this morning. I think it is a big challenge, and I think for investors that want to be focused on companies that are doing the right thing, it's important to ask the right questions. So if they have a project, what is it going to tangibly, how much money are they putting towards it? When is that project going to be up and running? Are there other elements of support that are needed? Is the technology commercially viable? Is there additional levels of, say, grid connection or sustainable energy sources that need to come in to meet, say, emissions targets of some of these projects? For ones that have more of a social aim, what are you actually trying to achieve? What are you tangibly going out to do? And how are you measuring success? Because I think that if you think that this is still an evolving space, that if you're making an investment in some of these companies, you want to be able to go with them on the journey to make sure that you're following along with management. There's going to be mistakes and setbacks along the way. I think there's a growing recognition that transition is very challenging. And so making sure that if you're investing in a company, they have that clear strategy, but that you have those regular check-ins and engagement points so that if something does go not quite to plan, that you understand why it didn't go to plan. Was it that there was something completely outside of the control of the company? And I think the companies that managed that process well were the ones that were very clear in their communications to investors, that were open about the challenges, but also open about what they were still doing. And so I think being very clear at the outset, but also having those regular check-in points with management teams to make sure that they are still on track, that you are making sure that if you are investing in them, they will continue moving forward towards trying to reach some of those aims. I think that that's a key piece, and it's something we're hearing investors are more focused on, is that engagement piece as well.
Do you think there is a role for investors to play in supporting those companies in the transition?
I think that people are realizing more and more that if you want to make transition a reality, you have to invest in some of those companies that are at an earlier stage in their journey. And to do that, you also need to make sure that you're engaging with them and bringing them along. So I think that you shouldn't just invest in any company, regardless who might have a good claim. But if you do that work and you see that they have a good plan to get from A to B, and that final destination is something which is much more sustainable, I think absolutely investors have a key role to play. I think one of the things that's come up a lot in discussions is the need to direct finance towards some of these companies that are in an earlier stage of transition. And I think that that is going to be a key component, but then making sure that you hold companies accountable on that journey as well is also going to be key to be able to prove to your end investors that you are doing or directing money towards companies that are actually making a difference.
It strikes me just the role of shareholder activists here. So do you think this is really getting some momentum? They are able to change the behavior of boards, for instance, or so and I will tell you the reason for this. So if you may reflect on this, or maybe anyone to reflect on that. Shareholder activism, I think now is getting the momentum. But what is controversial when we look at corporate response that I will reflect at the end? There was a proposal submitted to one of the biggest conglomerate in the world. I'm not going to mention the name. So shareholder activist proposal just ask the company to disclose about their climate risk. and the board of that conglomerate unanimously refused the request. So on one hand, we are really trying to push towards the sustainability agenda, but on the other hand, we sometimes see controversial response from corporate boards. And that's why I'm going to hand it over to Silvina. Silvina, if you could tell us a little bit more about what is the status of the green economy at the moment? Is it a dream or a reality?
It's a reality, the short answer. I think I can build a bit on what she shared. Green economy, if we defined green economy based on revenues, there are a few methodologies, but it is the important evolution of the ESG categorization in terms of companies' outcomes. As she said, it's the measure of the products and services generated by companies that really have a good positive environmental impact. Could be on adaptation, could be on reducing climate emissions, carbon emissions, could be used in waste management or recycling or participation in the circular economy. So when we talk about green revenues, it's just this concept of the results of the revenues. If we consider companies, if we consider the revenues, the green economy is today 10% of total market capitalization. In terms of sectors, is bigger than the bank sector, for example. So it is a reality, is big, is the third one. Of course, the first one is technology companies and so on, then came health, and then we have the green economy. It's not enough, that's the message, to achieve the 1.5 target for 2030. We need to be around 20% of the market capitalization. So it's, today we can say $6.5 trillion, it's a lot, and we are progressing, but it is still need to accelerate these trends.
There was a piece on the portfolio withdrawal during COVID, followed by the instability in Europe. And they found that the withdrawal of non-ESG portfolios is around 21% against 30% withdrawal of ESG portfolios. And again, this raised some interesting questions, not for you, but for everyone and even for academics. So why this is the case? So is it ESG really important in all times, good times and bad times, or we have something completely different in the time of instability? So it's always a big question that probably most of the academics, they are engaged in some research and some reports. We try to find an answer to this. And what's your view about investors' perspective? Is it long-termist or short-termist? What do you think?
I want to touch base on what you have just said around COVID times. And it is not only the short-term profit, it's the resilience, in my perspective, which is very important on the sustainability aspect. And in the London Stock Exchange, there is a green economic mark. So the companies that achieve this 50% or more than their revenues came from the activities I mentioned before, has this recognition. And what we saw in the first quarter of 2020, that when the market was very volatile, a lot of losses around, companies in the green economic market lost less than the rest of the listed companies in the exchange. So this is another important aspect. It's not only the good times or the bad times, it's on the long term, the resilience of the companies are very important to be considered, and the impact. And going back to your question, but I wanted to add that first, going back to your questions in terms of investors, we have just finished a survey to more than 130 asset owners around the world, and we asked them few questions. One of them was the adoption of sustainability in the investment and strategy. And 80% of the asset owners we had in the survey said that they are implemented already. It's a bit less than last year. This year was the 7th edition. But it is, in 5 years, we moved from around 40-50% to 80%. And if we are seeing Asia investors or European investors, the percentage is around 90%. So we can say that it's a new mainstream, or is how the financial markets operates, at least on the asset owners or big asset management types. There are two highlights from the survey this year that are very important to mention. When we talk about barriers to further adopt sustainability, it's on the data disclosure, on the data standardization. We think, and I think you will touch base later, but on the ISSB and the new reporting standards, there is a good future in terms of everybody talking about the same language, but it's still being data standardization of the data one of the key topics. The other point, which is different from previous year in this survey that arise in terms of investors, is the governance. This was one of the key things that all the investors mentioned as a priority. So it's not just the climate transition, but also going back to your points at the very beginning, the governance and the stakeholders are very important.
Excellent. Thank you, Silvina. Great points. And you already mentioned something about the data, and we're going to talk about that maybe at the end. But we have been seeing some guidance and directives and instructions from maybe the SEC or European Union, and lately we came across with the potential compulsory or mandatory standard. So Alistair, want to hear from you about the emerging global standards on impact measurement, and what does it mean to the UAE and GCC investors?
I was always taught that when you speak, 60% is how you say it. I think 30% is what you show, and only 10% is what you actually say. But to try and answer that question, he did warn me it was coming. I've got 2 slides I thought I might try to share. The first one is just, we talked a bit about definitions, and I can only endorse what Maggie has said and Silvina has said, but Maggie at the start around, what is sustainable investment, impact investment. It's not strictly defined or regulated what is sustainable investment, and that's semi-deliberate maybe because it's complicated and nuanced. What we would make the case very strongly for is, this picture up here, is taking a quick look at from what you might call traditional investing through ESG investing, where you're beginning to take into account of the risks and financial materiality of those risks in your portfolios, through to sustainable investing when you're looking to really drive better stakeholder results, through to impact investment, which is a very small niche area where you are very deliberately trying to address a specific social or environmental need and driving a social outcome alongside your financial return. But there are these different areas that they're becoming different asset classes. To Hisham's question, under the current, and I'm told yesterday they're changing again, but under the current EU SFDR rules, they've tried very clearly to demarcate what is an Article 8, what is Article 9. Maybe there's an Article 10 coming. I'm not sure what's happening with the changes. But they're trying to demarcate, and I think this is helpful. So we support, despite my upbringing as a small government, small regulation person, we do, and I do support regulation in these areas. So when it comes to what we might be contributing to the white paper, there is an element of regulation. Now, we don't have to go quite as far as Europe, which is always very well regulated, but I think there's some global standards coming, led by Europe, with the UK in strong partnership. And I'm not sure this slide's very easy to read, but Silvina just mentioned the ISSB, so the International Sustainability Standards Board. That comes under IFRS. So finally, we have a global accounting standard setter setting the rules for what should be measured around sustainability, around ESG. And I think, although I'll listen to the panel to tell me otherwise, this is very helpful. It's not just one of many different regimes. And by the way, there are currently 150 different disclosure authorities and regulatory sets across 35 countries, most of which are voluntary, some are mandatory. So there's this varied, and you have to ask that question every time you cross a border or even cross a province or a state. What are the rules here for what must I disclose? And the permutations come into the millions. So we're coming to a stage soon where I think there'll be a fairly common set under the ISSB of standards which everyone will be either requested or required to follow in their respective countries. And it will be similar to the financial accounting rules under IFRS. You also have to file your sustainability accounts. And this, we think, is a very positive thing. I've been in conversations in DIFC and ADGM. I know they're sort of anticipating this and already bringing this into play, looking forward to seeing if we can help them make that happen as well. But this slide really just tries to point out there are a lot of acronyms or alphabet soup, as Maggie said, still out there. The IFRS, ISSB, I think, is the most important one coming through. As you go from left to right on this slide, you start moving from measuring ESG metrics through to thinking about what we call double materiality, the scope 2, scope 3, the real impact of your actions and your products. And then we go a bit further, IFVI, VBA. You might not have heard of these. This is the International Foundation for Valuing Impacts, the Value Balancing Alliance. And those organizations are taking something more exciting, which I'm going to flash in front of your eyes, and don't take any photographs of it. But this is impact valuation. So what if you actually put a dollar monetized value onto impact? And I know there are 3 PhDs to come after me on this panel, so I'm going to be quite careful what I say or don't say. But this analysis, which is public information and has been released mostly through social media, takes a look at the EBITDA. I know Charlie Munger says EBITDA is, he uses an expletive when he describes it, but it looks at the EBITDA of these different food companies. And it also looks, using an open source methodology, at the product impact of their products. What does that product do for the world? So the green is their EBITDA, the red is their product impact. Now, how come these big negative numbers? So Danone, wonderful company. This data is from 2020, so it might have changed. Danone produces very tasty cakes and yogurts. And it's creating a public health disaster in Europe, diabetes, obesity, globally and Europe. So this computed health cost of its product takes into this very negative aggregate impact valuation. Whereas General Mills, the company on the far right, serving mostly disadvantaged communities with nutritious food, has a very positive health impact through its products. So this is not yet taxed, although maybe we will have a sugar tax in Europe quite soon, and maybe in UAE too, I don't know. But this kind of clarity of data, and I'll finish here, is just to say we think transparency of data, the more we can have transparency of the data, then the regulators and the governments can make their own decisions as to how they enforce it. But the one crusade we're on at GSG is just to help bring the data to the surface and make it as transparent as possible. And the regulators, I think, will follow the ISSB as a general rule now going forward. The SEC in the US has said publicly it will follow the ISSB as well, despite being gap accounting. So this strength of a sort of global standard, at least for the baseline, feels like it's really advanced in the last 2 years and is becoming real in 2024.
Thanks very much. Great comment. And so I think when we look at the examples you're referring at, so these are big names, is that right? So somebody would say, okay, how about small companies? How about SMEs?
This came up this morning, actually. What does this mean for the SMEs? And just before I answer, so this is the geography of GSG. A lot of our focus is very much on emerging markets where we want to be helping make things happen. So this is a great question of great relevance. And the SMEs, which sometimes represent as much as 90% of the economy in those emerging markets of Africa, Asia, and Latin America, are really critical stakeholders. So you can't apply the sort of complete toolkit that you might apply to a stock exchange listed corporate. But I think the investors, through the distribution channels, do want to see this level of information about their portfolios. So what must happen is a version of reporting is necessary up from the SMEs through their funds of funds or wholesalers up through to the investor. But it's different to what's being required. So the work that ISSB is doing was started with, as you said, those big companies. And the question they've set us, and we have an impact task force with the two of the members are serving as chair and vice chair of the ISSB, Emmanuel Faber and Jingdong Hua. And they've set us a task funded by the FCDO in Britain to make these standards or make a subset of them relevant in emerging markets and SMEs. And every country is different, every company is different, of course, but we all fit in the same ecosystem. So we are working very hard on bringing the sort of the process standards to be as inclusive as possible to the emerging markets by taking it almost on like a global roadshow for input, and then, if necessary, some adaptation around it. But it's not that we need a completely different set of standards, but they need to be sufficiently flexible so it's manageable. I'm an owner of 2 SMEs, and I don't want to be reporting ISSB straight away next year on my tiny little fintech startup in South Africa. But I do recognize that in order to attract capital, it will be probably helpful for me to be able to report on some simple, consistent metrics for the investors.
We all know that the backbone of the UK economy, the SMEs. And when we require them to report something like this, what is scope 2 and 3 for them? What is the understanding? What is the awareness? What is the mechanism for probably junior industry, young industry to report on that? So this is not a question, it's a matter of reflection for us to think together. So it's not easy, I think. So if these definitions are not settled in, even for big companies, so small and medium-sized companies will suffer the most, I would say. Do you agree with it?
You have to start with the big companies, I think, set the rules. But you need to be very conscious that the world, as you say, is not just about big companies. And I can't remember the stats for the UK, 50, 60% in the UK, 90% maybe in poorer countries. It's a huge proportion of the economy, and it must be included in the process.
Yeah, exactly.
I would like to follow up actually what
go
Alistair
ahead.
said, because I think it is so important. There's 2 things that come to mind. One is, and this is something actually Maggie and I, we were, at a breakfast earlier, and I think what came up is, so for instance, the measurement and the clear measurement or the clear illustration of data. And I think we are so far from it. And so, for instance, the simple chart of red and green, people can relate to. Right? I mean, a 3-year-old can relate to it. And that's sort of the level at which we need to engage in. And clearly the data needs to be right at the end of it. But it has to be visual, it has to be regular, it has to be in front of mind. And the reason that is because otherwise, I think, we always say we manage what we measure, right? And I always pick on GDP because it's such a detriment to us. I mean, GDP, what does it measure? It measures only what we are producing, but it doesn't measure the input. It doesn't measure clearly, all what we are destroying. So all it does is we know what we want, but we no longer know what we need, right? So we need the planet, but we don't. That's not in GDP. We don't measure it, so therefore it's irrelevant. But what we want, more consumption, more of this, that is what we are going for. By being able to measure and show on a regular basis what is the harm of what we are doing, that clearly is what is then changing. So I think we really always have to bring it, we can all talk quite sort of philosophically or theoretically or academically about it. But really, that's why we are doing what we are doing. And I think that's really important. And then you can also see what is doable, what is not doable. The second point I want to make with regards to SMEs, as you say, it's the backbone of pretty much every economy. So to then go and say, well, you know, that's too hard for you guys, sorry, you can't do it. Well, the way it is going to come in, and yes, you know, therefore it has to be clear, because we don't want somebody to chase their tails. And generally what I see, SMEs tend to be quite conservative in many ways. So they then go and say, no, you know what, I already have so many risks, I'm trying to minimize it, I'm not spending any money on this unless you tell me very much what I really, really need to do, because I don't want to do it. But what we see where this is coming in, and this is, you know, I'm an investor, so this is the asset owner. I don't own it directly, but clearly the asset owners give the wealth to us for us to invest. And so what we know from the asset owners and what we know from regulation is that the big companies clearly work with the smaller companies, and they need to ask those smaller companies for a certain transparency. And that's the supply chain, right? Because that is the scope 2, for instance, maybe the scope 1. So it's really, really important to bring those in under the scopes, because oftentimes you are importing those scopes, right? So I think from that regard, and it will come most likely from the big corporates who are working with smaller companies. When it comes to carbon reporting, you know, clearly all I just said applies to carbon reporting just as much, to know where things are coming from and what we are reporting on. As somebody mentioned, for instance, you know, there's some companies where they say, you know, they go to net zero, but they only include scope 1, scope 2. And if scope 3 clearly is, you know, the large component, then that doesn't really get us very far. So an oil and gas company to go and say we are net zero under scope 1 and 2 just means they stop flaring, right? But they would still produce whatever output they're producing, that then scope 3, it means that there is the emission. So those details, you know, how are you allowed to report is also really important. And then for us, you know, talking about emerging markets, I mean, I think there was a conversation actually also early on, right, where how many emerging markets, what is the most of the emissions, where they're coming from, especially if you include China, but also clearly India into the emerging markets. This is where 60% of the future emissions will come from. So it's really important to be able to see also in emerging market, what is the carbon that they're emitting, but also how can we count when they are transitioning or when they're using less. So what is the impact reporting on the carbon that has not been emitted because of the investments that we are making? I stay at Bloomberg day in, day out. So you have all the economic releases, for instance. So you do CPI, PPI, retail prices, you know, lending standards, manufacturing surveys, all sorts of data that you get on a regular basis. So to the extent that we are starting to bring in the sustainability measures and they have to be reported on a very regular basis at a macro level even, so that we know, you know, we know what US GDP is, we know what German GDP is, we know what, you know, the UAE GDP is. And that requires a lot of effort to actually collate the data, right? You have to go to every single company and sort of see how that works. And still we go through that effort. And so, you know, this idea that the effort is too large and we can't do it is, you know, it makes no sense, right? When you look at what we have already. And so this is the same, you know, sort of expectation, I think, that we need to have, that we say, so what are the positives and the negatives? Because otherwise it is very easy to only point to one side, and you have, you know, a conversation, 80% of the 10% of good things you do, and then you leave, you know, everybody leaves the room feeling good, but you forgot about asking about the other 90%, right? So that's really where we need to get to.
Yeah, that's a great comment. And my second point of reflection of what you just mentioned about the countries that they are responsible for, probably, as you said, 60% of CO2 emission, probably few countries, maybe 5 or 6 countries. And we, without naming anyway, we are all aware. So what are those countries? And they are quite skeptical about the 2050 or 2030 net zero target. It's not a question, but we hear a lot about what is called the ecosystem integrity. I don't know whether it is included under this definition, or what does it mean in your view?
So, I mean, that is something that I think that debate is now really starting to rage. That came up, I think, who dug it out originally was the actuary community. So the actuary community, you know, what do actuaries do? They need to do long-term forecasts, right? Because they need to tell pension funds and insurance companies how much can they pay out, how long do we all live. So this is, you know, a difficult task. They are highly mathematical, and they need to be right. A lot depends on it. And the actuary community actually started to speak up this summer. And the reason they spoke up was because they looked at what the climate scientists are saying with regards to what will be impact on the famous GDPP if temperature rise to 3 degrees or 4 degrees. And what they noticed is that what climate scientists are saying and what the financial community is forecasting, and what the economists are forecasting, there is a huge gap. And that actually is all going back to somebody who just recently got the Nobel Prize for Economics, Mr. Nordhaus, and he forecasted, you know, admittedly about 30 years ago, that if temperatures rise to 3-4 degrees, GDP will be, you know, continues to be higher. And so, for instance, you know, the famous 115 central banks that are coming together to green the economy, they're using those forecasts. So that's why what they're doing is that they say, okay, if the temperatures goes up by 3 degrees, GDP will be negatively impacted by 0.5%. And why? Because there are no tipping points. So the glaciers are not melting, the sea levels are not rising, the biodiversity is not going to die out. You know, sort of there is those sort of things that have completely dismissed. So all that have been put in total those analyses by economists is that they say, oh well, you know, if we have 20 hurricanes under the current climate, then it's 3 times more. So we'll have 60 hurricanes. And that was all the analysis that has been carried out. So we are forecasting our GDP growth, we are forecasting our financial returns on a completely flawed model. And as we are now seeing, the temperatures have gone up by about 1.5 degrees, or just shy of, and the impacts we can see already, we are now starting to realize, 3 degrees may really be something we need to take notice. And so I think that is really, again, bringing it down just to the most basic level, is that what scientists are telling us, what will happen, has not yet reached the financial markets. And so once this is my premise always when I say, look, if we were to set aside 1% of all financials outstanding to invest in climate change mitigation and adaptation, we get a decent return. Single digits is not going to shoot the lights out, but nice single-digit return. So you can actually fund many of the projects, so that it doesn't get too expensive. But very, very importantly, by setting aside 1% of our assets to tackle the issue, 99% of our assets will get safeguarded. And isn't that the big price? Because at the moment, we think we can continue and our 7-8% a year will just roll in, right? And I think that is the big penny dropping moment that we need to understand, that we do it for not just for our well-being, for what we need, but we also do it for our future financial returns that we clamor so much over.
Yes, great. Thank you, Dr. Tatiana. My final question to all of you, so don't put you on the spot. In your probably specialization, what you would like to see the outcome of COP28?
we would like to see from this COP and future COPs too is a commitment by countries and their regulators to applying a global set of standards for measurement.
Someone asked me the same question a few days ago, so you are not the first one. But we had a meeting with our CEO that came for the opening on the COP and said, like, okay, after day 4, are you more optimistic or pessimistic? And he asked the question all around the meeting room. And the ones I'm responsible for emerging markets, I was one of the ones that said I'm more optimistic. And the others around that are based in emerging markets or are coming from different regions, they are optimistic. Probably is where we are seeing, and the reason why, because I started thinking why it was so clear the distinction between the delegation that's coming from London, for example, and us in the emerging markets being more optimistic. And I think that it is, in many cases, this COP is very inclusive from different stakeholders. There is a lot of collaborations to be done to make sure that the targets and the commitments are met. Even this morning, I was in the DIFC with a discussion on Islamic finance. So it's the first time that it is a lot of discussion about Islamic finance participation in the transition financing in general. So there is a lot of stakeholders into the discussion. On Sunday, the Green Zone, another great discussion with the youth delegation from China, from Japan, from universities all around the world, discussing also these type of things and how to accelerate on the innovation side. So we will see the outcome at the end, but I think that the most promising thing is that all stakeholders are in the table, and there is a lot of discussion of what is important now from carbon perspective, but also nature and the TCFD and what is coming next, and biodiversity, and these are key things for the future.
I think I would touch on those points of inclusivity and collaboration. I think that one of the things that often comes up in discussions is that governments definitely have a key role to play. They need to create the right incentives. They need to create the right business environments for things to move forward. But companies also are closest in some ways to those options to create solutions. So bringing everyone together, having those discussions, fostering collaboration, I think that that's going to be the key piece, because transition is complicated and it's messy, and it's only by people working together and also by sharing ideas. What's worked for you? What hasn't worked here? What has this country tried? What has that one tried? What's actually working? Where are you getting the results? And then channeling more resources there. That's what, when I'm listening to the discussions around me, that I'm excited about.
Optimistic. So I think, what was it, 10 years ago, maybe 12 years ago, we were heading to about a 5-degree increase. Now we're heading to around 2.5 to 3 degrees increase. You know, we're going in the right direction. Yes, we need to accelerate. But, you know, a few years ago, we were still, is it really, you know, maybe, there's something else more important. So there is, I mean, we are definitely at the acceleration space. There's an acceptance now, and acceptance is the way to change, right? We need to accept first, otherwise we can't change. The acceptance is there, so there's definitely that willingness. So yes, optimistic, because we are now have already halved the degrees that we are heading towards, and I think there is a room for more.
And one thing just I want to share with you, for instance, linking from the previous panel, I think one of the panelists mentioned about the way forward is the innovation, which I personally agree. So innovation and technology will play a key role in tackling the challenges we are facing, not only in climate change, but maybe in others. But the way we do it is going to start from a robust research. In academia and leading universities like ours, we engage in rigorous research and rigorous methodologies. And why I'm emphasizing on this point at the moment, you would see, I'm sure, everybody on LinkedIn, I'm sure that. And you can see that the recent trend 2 or 3 years ago up till now, that some of the leading academics, we will not name anything or any company or any academic, start to highly criticize the reports created by some probably practitioners, linking, for instance, give example, say the relationship between gender diversity and financial performance, for example. So those type of research questions that were acceptable 20 years ago in the research and academia is not acceptable now, because the landscape in the methodology, especially in the area of finance, has been shifted really very, very fast. And the way we can see some modeling and some in-depth analysis happening in our discipline that completely change the story. And why I'm saying that? I'm saying that because we are all on the same boat. It's not a separation between industry and academics. No, we are all working to inform policy. We are working to inform our clients. We want all to make the right decisions in the right time. Without the proper methodology, unfortunately, we're going to end up with probably not the right decision and not in the right time. So one thing that we have been dealing over the past probably few months or maybe more, that the momentum of ESG data is coming, and the variation on most of the databases, again, we're not going to mention any, but what's happening is one of our colleagues in one of the leading universities, they did some research on a data downloaded 5 years ago and repeat the research again now on the same time frame, and they found different results. So this is quite dangerous, because consistency of the data is important. Rigorous methodology is even more important. So how can we do that? And I think this is the role of the interaction, or the positive interaction between academics and professional services. So this is what I want to conclude. And in this panel, I think I hope you enjoyed the discussion. We discussed very important points. So please give a round of applause to our panelists and to thank them very much.